It begins with a political earthquake. Democrats and Republicans enter a state of total legislative gridlock, refusing to negotiate or compromise on any major policy, budget, or legislative initiative. Government operations slow to a crawl, and public confidence in political institutions begins to erode. The media broadcasts daily confrontations, policy deadlocks, and partisan clashes, reinforcing public anxiety. For decades, the U.S. economy has relied not only on market forces but also on predictable fiscal and regulatory oversight. Now, the uncertainty created by total political dysfunction threatens the very foundations of economic stability. The first immediate impact is seen in fiscal policy. Budget proposals stall indefinitely, leading to partial government shutdowns and interruptions in essential services. Federal employees face furloughs and contractors see payments delayed, reducing household income and consumption in affected communities. Stock markets react quickly to the uncertainty, particularly indices sensitive to government contracts, defense spending, and infrastructure projects. Investors price in risk from delayed public projects, regulatory uncertainty, and potential economic slowdown. Financial markets experience acute volatility. Traders, hedge funds, and institutional investors struggle to anticipate policy outcomes or lack thereof. Bonds reflecting government debt see fluctuating yields as confidence in the U.S. Treasury's ability to maintain fiscal stability wavers. Stock indices across industrials, defense, infrastructure, and consumer sectors experience sharp swings, reflecting both risk aversion and speculative positioning. Corporate strategy is thrown into turmoil. Businesses dependent on government contracts, federal regulations, or public financing face operational uncertainty. Companies delay expansion, hiring, and capital expenditures, adjusting forecasts to account for potential policy paralysis. Stock valuations for firms tied to federal programs or heavily regulated industries adjust downward as analysts anticipate stalled approvals, delayed projects, or budget shortfalls. Trade and international relations face indirect consequences. Foreign investors monitor U.S. political dysfunction, reassessing risk in U.S. markets and currency exposure. Trade negotiations stall, and international agreements face renegotiation delays. Stock markets for multinational corporations and exporters fluctuate as investor sentiment shifts, reflecting concerns over U.S. stability and global competitiveness. Consumer confidence suffers. As news cycles highlight partisan conflicts and government ineffectiveness, households become more cautious with spending. Large purchases such as homes, vehicles, and durable goods are delayed, reducing revenue for manufacturers and retailers. Stock valuations in consumer discretionary sectors respond to reduced demand and increased uncertainty about economic growth. Employment markets are affected in multiple ways. Government contractors, federal employees, and service providers face furloughs or layoffs. In the private sector, uncertainty in policy, taxation, and regulation slows hiring, leading to reduced workforce growth. Stock markets for employment-sensitive industries, including retail, construction, and consumer services, reflect anticipated reductions in consumer spending and labor mobility. Financial regulation faces inconsistencies. With legislative deadlock, oversight agencies struggle to implement new rules or update existing regulations. Banking, investment, and insurance firms face uncertainty regarding compliance, risk management, and operational planning. Stock valuations for financial institutions fluctuate as investors price in regulatory unpredictability. Debt management becomes a central concern. The inability of Congress to agree on borrowing authority, debt ceiling adjustments, or fiscal policy triggers market anxiety. Treasury yields rise as investors demand higher returns for perceived risk. Stock markets experience heightened volatility as bond and equity markets reflect concerns over government solvency, interest rate risk, and potential default scenarios. Inflationary and deflationary pressures emerge simultaneously. On one hand, delayed government spending reduces money flow in certain sectors. On the other, fiscal uncertainty and supply chain disruption increase costs in others. Stock markets for commodities, consumer goods, and industrial materials respond to uneven price pressures and investor sentiment. Corporate mergers, acquisitions, and capital raising face delays. Regulatory approvals, antitrust reviews, and industry oversight become unpredictable. Companies postpone strategic initiatives, affecting growth projections. Stock valuations for sectors reliant on M&A activity fluctuate as uncertainty dominates decision-making. Technology and innovation sectors are indirectly affected. Government funding for research, grants, and defense-related projects stagnates, reducing the inflow of capital for innovation. Startups and established firms alike face increased difficulty in planning long-term research initiatives. Stock prices for technology and biotech sectors reflect delayed public investment and heightened risk. Infrastructure projects slow or halt entirely. Transportation, energy, and public works initiatives reliant on federal approval or funding face delays, reducing revenue for construction firms and suppliers. Stock markets for heavy industry, construction, and engineering companies reflect projected declines in project throughput and profitability. Consumer finance is impacted by market uncertainty. Credit conditions tighten as banks adjust for risk associated with political instability. Mortgage rates, auto loans, and personal credit terms become more volatile. Stock valuations for banks and financial services firms respond to anticipated reductions in loan volume and increased default risk. Corporate debt markets experience increased spreads. Firms dependent on predictable government policy for contracts or revenue face higher borrowing costs. Stock prices for corporate bond issuers reflect risk-adjusted expectations of higher interest expenses and operational uncertainty. Energy and utility sectors adjust. Projects dependent on federal approval, environmental permits, or public funding are delayed. Renewable energy initiatives, fossil fuel exploration, and nuclear projects face operational uncertainty. Stock valuations for energy providers fluctuate based on anticipated project delays and regulatory uncertainty. Labor relations experience heightened tension. With government contracts and employment delayed, union negotiations and labor disputes increase. Wage growth slows in affected sectors while labor productivity may decline due to uncertainty. Stock markets for labor-intensive industries reflect potential disruptions and operational inefficiency. International capital markets react to U.S. political dysfunction. Foreign investment in U.S. equities, bonds, and real estate slows as investors seek stability elsewhere. Currency markets reflect reduced confidence in the dollar's short-term stability, influencing export competitiveness and multinational corporate revenue. Stock markets for export-heavy sectors adjust to these macroeconomic factors. Corporate governance faces unprecedented pressure. Boards of directors must navigate operational uncertainty, regulatory unpredictability, and investor demands under an unstable political environment. Firms demonstrating proactive strategy and resilience see stock appreciation, while those unprepared experience declines. Consumer spending patterns become cautious. Households delay discretionary expenditures, prioritize savings, and reduce debt accumulation. Retail, hospitality, and travel industries experience revenue declines. Stock prices in consumer-driven sectors reflect anticipated reductions in cash flow and demand. Financial institutions increase capital reserves. Risk assessment models adjust for heightened political uncertainty, potential government default, and market volatility. Stock markets for banks and financial services reflect investor assessment of sectoral resilience and risk exposure. Corporate strategy increasingly emphasizes risk mitigation. Firms diversify supply chains, delay international expansion, and limit exposure to sectors sensitive to government contracts. Stock valuations respond to perceived operational prudence and long-term stability planning. Trade policy stagnation affects import and export activity. Tariffs, quotas, and trade agreements remain unresolved, creating uncertainty for U.S. manufacturers, exporters, and importers. Stock markets for trade-reliant companies experience volatility based on delayed policy decisions. Small and medium-sized enterprises face challenges. Uncertainty regarding taxation, regulation, and federal programs reduces business confidence, delaying investments and hiring. Stock valuations for publicly traded SMEs and related service providers reflect risk-adjusted projections. Consumer credit and debt markets tighten. Credit card utilization, auto loans, and home financing are influenced by reduced economic confidence and higher perceived risk. Stock markets for consumer finance, lending institutions, and credit service providers reflect these adjustments. Housing markets experience regional variation. Areas dependent on federal employment, contractors, or public projects face price stagnation or decline, while private sector-driven regions may experience stability. Stock valuations for real estate investment trusts, i.e. REITs, reflect differential regional exposure. Corporate taxation uncertainty increases. Firms delay strategic investment decisions while awaiting clarity on tax law changes, incentives, or federal programs. Stock markets respond to projected revenue and expense volatility resulting from legislative inaction. Infrastructure-dependent sectors experience cascading effects. Transportation, telecommunications, and utilities face project delays, reducing near-term revenue and operational efficiency. Stock valuations adjust to reflect anticipated stagnation in critical infrastructure development. Financial derivatives and hedging strategies adjust. Firms exposed to political, currency, or interest rate risk implement hedges, influencing liquidity and market dynamics. Stock prices for derivative providers, trading platforms, and risk management firms respond to increased demand for risk mitigation. Corporate mergers, acquisitions, and international expansion face delays. Regulatory approvals and international coordination stall, reducing growth prospects. Stock valuations for companies pursuing strategic expansion adjust to reflect policy uncertainty. Technology adoption accelerates selectively. Firms invest in automation, efficiency, and digital solutions to mitigate workforce disruptions caused by government gridlock. Stock markets for technology providers reflect opportunity in operational optimization and risk reduction. Consumer behavior shifts towards savings and essential spending. Retail, travel, and luxury sectors experience reduced revenue, while essential goods, healthcare, and utilities maintain stability. Stock valuations reflect sector-specific consumer behavior patterns. Financial markets remain volatile in the short term. Stock indices fluctuate daily as political news dominates market sentiment, creating a challenging environment for investors seeking stable returns. Sectoral divergence is pronounced, reflecting differing exposure to government dependency and fiscal policy. Corporate debt markets adjust to heightened risk. Firms with exposure to federal contracts face higher borrowing costs, while diversified companies maintain favorable credit terms. Stock prices for lenders, insurers, and bond markets reflect recalibrated risk assessment. International relations face indirect consequences. U.S. partners monitor domestic political dysfunction, influencing trade negotiations, defense collaboration, and foreign investment decisions. Stock markets for multinational corporations respond to changing geopolitical and economic risk profiles. Energy, healthcare, and essential services sectors remain relatively stable. Demand for basic goods and services persists despite political uncertainty, while infrastructure-dependent industries experience revenue disruption. Stock valuations for resilient sectors reflect investor confidence in sustained cash flows. Labor markets adjust gradually. Workforce development programs expand in private sectors less dependent on government policy. Employment recovery in affected sectors is slow but ongoing. Stock markets reflect the interplay between labor availability, productivity, and economic growth. Corporate governance and risk management become central to investor evaluation. Firms demonstrating adaptability, financial prudence, and strategic foresight outperform peers, influencing stock performance. Consumer confidence and market sentiment gradually stabilize as businesses adapt. Political crises become predictable, and policy negotiation patterns emerge. Stock markets respond to the restoration of partial certainty, sector-specific opportunity, and long-term growth projections. Government and corporate collaboration slowly resume in essential sectors, while legislative gridlock continues in less critical areas. Stock indices reflect differentiated exposure, with resilient industries outperforming those highly dependent on federal decision-making. Global markets monitor U.S. political dysfunction. Currency fluctuations, trade uncertainty, and investor sentiment influence capital allocation decisions internationally. Stock markets for globally exposed firms reflect macroeconomic risk from domestic political paralysis. Financial institutions recalibrate long-term risk assessment. Investment strategies diversify and hedging mechanisms adjust to political unpredictability. Stock prices respond to both cautionary measures and opportunity in risk-adjusted markets. Consumer markets gradually adapt. Spending patterns normalize in resilient sectors while discretionary spending remains cautious. Stock valuations for consumer-focused companies reflect emerging patterns of recovery and continued risk awareness. Corporate innovation focuses on operational resilience. Companies invest in technology, supply chain diversification, and strategic planning to withstand future political deadlock. Stock markets reward firms demonstrating long-term adaptability and foresight. The scenario illustrates how a total breakdown in cooperation between Democrats and Republicans would ripple across the U.S. economy. From fiscal uncertainty and market volatility to employment challenges and consumer behavior shifts, the impacts would be widespread and complex. Stock markets reflect both immediate disruption and long-term structural adaptation, highlighting the profound interconnection between politics and economic stability. Ultimately, sustained political dysfunction would redefine investment strategies, corporate planning, and public confidence. While short-term volatility would dominate, long-term adaptation by businesses, consumers, and policymakers could stabilize markets and potentially create opportunity amid systemic uncertainty.